Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 25th, just after the close. I'm with the Moose. We're going to ask Moose a few questions. He's had his eye on the bond market all week. Saw a lot of volatility there.
Tremendous. Long time. Probably got to go back 30 years to see the kind of volatility we're seeing in the bonds.
Yeah, it seems in bonds, and we'll jump back to equities in a moment. It seems in bonds every 10 years, unlike equities, where it's every 2 to 3 years, every 10 years you get 2 or 3 wild trading situations.
And you have them now.
Yeah, you have them now. Yeah. Rates heading higher. What's that doing to the equity market? Areas that have traditionally performed well on the early part of a rate rise are performing well. Financials, very solid week. So commodities continue to trade well. Energy trading well. Metals and miners trading well, both domestically and internationally. We do own both domestically and internationally in tactical trend and our international portfolio. If you remember, now going back 2 or 3 weeks, we did take half off the table in metals, pulled back a little bit, thought we could refill on a further pullback. Hasn't come back for me, John. Right. Now it's higher than where we sold. That's going to happen. And that gets in a little bit to what we discussed in the real nasty days of late February when the NASDAQ was down 20% intraday. S&P was down 12, 13% intraday. And that was just trying to dampen your allocation versus make that all-in, all-out decision. Right. We see it in bonds too. You can see it in commodities. We try to get investors and traders thinking about not making that light switch move. And there are people there that were sellers in late February. They're in cash now, and what do? The NASDAQ's gone from down 20 to down 10. The right. S&P's gone from down 14 to down 5. Right. Now what do you do if you made that all-out decision? Versus right. I like to think of it as a dimmer, and we did dim in some accounts, some strategies, which gave us the opportunity to start to rebuy. So that is something we follow. Over on the fixed income side, that goes to the truth as well.
Very similar, Matt. And think about it. This week, tough week for bonds with yields up basically 30, 35 basis points in the front end of the curve, even more 2s and 5s. You have a situation you don't have very often. You have the 5-year bond in treasuries yielding you basically a 256, 10-year bonds at a 248. You call that inverted. Well, not quite yet, and you have to sit there for a while. But the real story...
You make a great point there, John. I hate to cut you off, but we have a conversation. Yeah. Some people, as soon as they see an inversion, or as soon as in the equity market they see a 200-day or a 50-day get breached, 50-day moving average, that to them is danger. I've always thought, while it's noticeable, it's how long does it remain under the 50-day or the 200-day, or how long does the bond market remain inverted?
Right, and those curves, and really it's more like 2s to 10s, but it really has to be for a few weeks, even a couple of months, and then you can really say, boy, this is going to cause some issues for the banks and trying to basically borrow in short term and lend longer term. You're nowhere near that yet. What you are having is a reaction to the Federal Reserve, who has come out and said they need to raise short-term rates, and they may raise them faster as they go forward, depending on what they see on inflation. As we go through the rest of this spring and summer, what we see on the inflation front is going to be very important to what we do. Are there attractive bonds out there now? Yes, for the first time in a long time. You're buying long, high-grade tax-free munis, close to 4%. It's been a long time since that. And remember, people might say, wow, but inflation's still running at 7. It won't be running at 7 forever. When you end up back at a longer-term run rate, higher than it was at 2,
sure,
but maybe not at 4, maybe at 3, those 4% tax-free yields are going to look great. And some of these close to 5% taxable yields are also going to look good. So we're using this period as a time to extend maturities and durations to basically buy yield that we haven't been able to buy. And what we try to tell investors is that whereas at it's a little painful to go through when you see bond values of existing bonds going down. What it's really a signal is that for an active bond manager like ourselves, it's somewhat opportunistic because you're able to basically up the investable book yield on portfolios over time. And that, in the end, is very good for portfolios.
Absolutely. And let's spend a moment on getting some transparency to what you just said. What we see on the short end of the curve, bonds maturing in 1, 2, 3 years, they don't move much.
No, because
maturity
they're
is
short.
tight.
Even when yields rise, there's not a whole lot of price movement.
Right. But talk a little bit about what you see 20, 25, 30 years out and some of the forced selling that you see that you're able to step into. That bond market's not efficient at 25, 30 years. Talk about that.
Anything but efficient. So what happens is a bond fund gets hit with redemptions. They don't sell what they would like to sell, which might be a credit that's gotten downgraded or something. They sell what they can sell, which is usually high-grade bonds. So without naming a particular name, we bought some high-grade long, not even that long, less than 20-year GOs this week at 75 cents on the dollar. 2% bonds that were issued last May at around 96 cents on the dollar. So down over 20 points, which is 10 years worth of coupon payments. I will tell you that being able to own that is attractive. How are you able to buy that at 4%? Because the market really isn't at 4%. You can only buy it because someone is willing to sell it to you because they have to get rid of it.
Right.
And this is a great environment for managers like ourselves.
So you're seeing forced selling. That's kind of a buzzword we talk about, whether it's fixed income or equities. Stepping into forced selling.
Right.
Short term, that can be painful. It can take your breath away. It can be nerve-wracking. Longer term, being a forced sale buyer has traditionally been a wonderful guy to be.
Yes, and I think the best part about that is that for investors that have separately managed accounts and own individual bonds, and you may see some shorter term or intermediate term impact on prices here, it is not forced selling, which is what you see when you own a bond fund where you're subservient to one price only, and that's the net asset value of that bond
That's
fund.
it. Great info, because bonds, unlike equities, sometimes there are intricacies to bonds that our investors and our listeners don't follow day to day. And
Right.
I think it's important to let them know what you're looking at and how taking advantage of that long end, that inefficient end of the market can reap benefits going forward.
It's very true. And as you sit there and you say, boy, there's some shorter term pain here in bonds, that coupon is still paying.
That's it. Great. Everybody enjoy the weekend. Don't forget to like and send any questions to us. We'll try to get back to you. Enjoy the weekend. We'll see you next week.